Hi folks, Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory, and we thought we'd come to you today with a brief market update, kind of let you know what has been going on this week, which has been a very turbulent one. The NASDAQ is on track to lose about 7% this week. S&P 500 and Dow are on track to post their third weekly loss in a row. Certainly, markets are a little bit upset right now. We thought we'd explain a little bit why that's happening. Treasury yields have spiked from about 1.5% at the beginning of the year to about 1.9%, a high on Wednesday of this past week, in response to inflation and in response to Fed efforts to contain that inflation. A greater expectation that they're going to raise rates higher and earlier, withdraw a little bit of money out of the system, is pushing rates up. Something that's important to understand about interest rates is every bond, every equity that's out there is effectively, at the end of the day, a promise of future cash flows. So when you buy a bond, that's pretty obvious. You're buying a future cash flow stream. When you buy a stock, that's a little bit less obvious, but you're buying ownership of the company, an ownership share of the company. And with that ownership share comes a share of the expected future profits of the company. So in a way, when you buy a stock, you are buying a future stream of profits from that company. Now, the thing about future cash flows is that when interest rates go up, the value of those cash flows go down. Said differently, if I'm promised $100 a year from now, when interest rates are at 5%, that's worth one amount, around $95. If interest rates are all of a sudden rise to 10%, then the value of that cash flow drops to about $91. And I'll leave that for you guys as a math problem to work out at home if you're so inclined. But anytime you have a promise of future payment, when interest rates rise, we see the value of that promise go down. And that's exactly what's happening, particularly when we look at the NASDAQ and other sort of tech-heavy indices. A lot of these indices have companies with very, very high valuations, companies where they're growing very quickly, and so the expectation of future cash flow payments is very far out in the future. And as interest rates rise, if your cash flow payment, the one that you're betting on, is very, very far out in the future, you have to pay the rising cost of that interest several times versus maybe an investment that is more has less lofty future cash flow goals. So said differently, the S&P 500 growth sector is significantly lagging this year, very negative. My guess, I haven't seen it. My guess is it'll end the day down about 10% or more for the year. Whereas the S&P 500 value sector is basically flat, maybe has lost a little bit. I think that's important to understand that what is going on is fundamentally a valuation problem. Nobody is waving a flag on any of these companies. Nobody is saying that Netflix or Amazon or Google or any of your high-flying companies previously are bad companies or that their business models are imploding. It's not the same as the 2001 dot-com bubble when you had a bunch of companies that weren't making money, that were valued at extremely high multiples. This is more of a valuation issue. And the nice thing about valuation issues is that they are ultimately self-correcting. It's a question of how far down that needs to go. But if you liked that stock at $100 and it trades to $95, based on interest rates, it fundamentally becomes more and more attractive the lower the price goes, so long as these things are generating profits. So that's a brief synopsis of what's going on. I would expect markets to continue to be turbulent. We are in the middle of earnings season, and the inflation interest rate picture is still trying to figure itself out. But part of diversification, as we always say around here, diversification means always having to say you're sorry. In a well-balanced portfolio, you're going to a little bit of growth and a little bit of value. The growth stocks are underperforming right now. The value stocks are outperforming. And once again, diversification means always having to say you're sorry. So with that, as always, if you have any questions, please, please, please reach out to me or to your advisor. I hope you're having a great day, and I look forward to talking to you again soon.
Thank you for tuning in. And if you're enjoying this content, please subscribe to our YouTube channel and click the bell to be notified when we post more.